The second way is to try and support demonstration transactions, where we try to design appropriate structures of vehicles in partnership with relevant market stakeholders. And of course, the third, we appreciate the importance of knowledge, research, advocacy, and training of relevant stakeholders, where this particular study actually falls. So the study, we commissioned this study in partnership with Lions Head Global Partners in July 2021 under the program. And the objective is to try and get a better understanding of private debt markets. So we wanted to get a deeper perspective on various aspects when you look at size, evolution, management structures, the actors in the market, regulation, investment appetite, and so on, specifically related to private debt. And this is also particularly because when you look at private equity, data around private equity is more actually available compared to private debt. Or in some cases, the data on private debt is aggregated with the data on private equity. So you don't have sort of broad or just available data on private debt. But we thought it might be good to understand the market, particularly because there may be a case for it, particularly again with institutional investors. And when you look at it from the concerns that the institutional investors have, when you look at private equity as an asset class, they talk of maybe the J-curve effect, cash flow management issues. So these are things that maybe are less prominent when you're looking at private debt as compared to private equity. So we thought there's actually a higher potential in the private debt markets in terms of increasing institutional investors, institutional investor capital into the market. The expectation from the study is that the findings and recommendations will then inform some of the initiatives under the Africa Private Equity and Private Debt Program. So the three that I mentioned, whether it's regulatory initiatives, whether it's transaction support, whether it's training or capacity building engagements, and so on. But more importantly, we want to sort of understand the potential role that private debt markets can actually play in financing Africa development and developmental and economic priorities. Yeah, so that is a brief background. I'd like to just invite Daniel to then proceed and make the presentation. And also he will give an outline of how the format of the session will be.
Thank you very much, Brian. In terms of the agenda, Brian just covered the introduction and overview of the projects and what we'll be doing today. So I will present highlights of findings from the report, recognizing that in this forum, we can't cover the whole report in detail, but we'll attempt to cover the headline items. And then after that, we'll have a panel session, and we'll introduce the panel at that point. And after the panel session, we'll have a chance for questions and answers. And finally, we'll close with closing remarks from Evans. Just in terms of introductions, I'm Daniel Musili from Lions Head Global Partners. I'm a director based in the Nairobi office. And Lions Head is an investment and asset management firm operating in frontier and emerging markets. And really, we work with clients such as DFI, sovereigns, corporates, and financials, financial institutions, foundations, and really advising on a range of transactions. Many times, these are first of their kind transactions in those markets, covered through our offices in London, Nairobi, Lagos, and Dubai. Going into the presentation itself, we'll cover the background of the study, although Brian has highlighted that will give an overview of private debt in Africa. As part of this project, we actually spoke to market participants drawn from Kenya, Nigeria, Ghana, and Morocco, as those were the key focus markets for this study. And we also spoke to a number of players from South Africa and some with Africa-wide operations, just also to give context to the study. And so you will see a lot of the focus is on those 4 markets. Broadly, we'll just go into the overview. We're looking at private debt as investment of capital in an unlisted format. So all forms of debt financed by non-bank lenders, but outside of the public markets. In Africa, we saw that the private debt market, there's a lot of input from the DFIs and multilateral development banks, and we'll get into why that is. But increasingly, we're seeing specialist funds that are able to build on precedents set by DFIs and MDBs to become an increasingly important social supply of funds for Africa. And then in terms of currency, we've seen that offerings are still to a large extent in hard currency, so local currency offerings are in the minority, but we see this changing, especially with the establishment of domestic funds operating fully in local currency. And also we're seeing some of the international funds, how they've developed the capacity to be able to hedge and offer local currency and foreign currency lending. The key strategies covered under private debt include direct lending. Many times this is senior debt. Distress debt, which is more specialized for companies in default or near default, especially where the lender thinks they can turn around the company and be able to recover the investment. We see a lot of mezzanine, basically subordinated or preferred equity with fixed coupon and again, maybe ability to convert to equity. There's also private debt funds of funds. So instead of lending directly, pretty much investing in the debt funds that will then lend to borrowers. There's also special situations, which is more opportunistic. And then there's venture debt to the very early stage companies. We'll see this later in the presentation, but we found that mainly on the continent, a lot of the lending is just senior debt or mezzanine. In terms of what's happening or the trends, as I mentioned, we're seeing momentum building, and this is especially in the areas of interest to the international development finance community. And this includes access to energy, renewable energy, access to finance, infrastructure, and transitioning to lower carbon economies. The mezzanine asset class, there have been players who've been there for a while, so it's well established. In terms of recent events, we've seen funds like Africa Go Green, which is focused on transitioning to lower carbon economies. Recently closed $39.5 million, and they're still fundraising and anticipate to close around $170 million. Vantage Mezzanine announced a fast close of more than 200 million in 2021. Blue Peak as well announced more than 110 million fast close. There's 2 funds here under the Facility for Energy Inclusion. So there's the on-grid and off-grid funds. We've raised more than 300 million and continue to raise additional capital. Ethos Mezzanine, Sun Funder, and the social investment managers and advisors, all working on raising funds. So just in the last 18 months or so, there's more than $1 billion that's been raised just to go to private debt within Africa. And on this slide, you can see some of the other actors that are active there. In terms of what the returns look like, typically this is an area that doesn't have a lot of published data, but in our research looking at emerging markets and in Africa, the returns vary by the strategy employed, and then they also vary by the geography and the structure. So when we're looking at just direct lending, returns average out at around 7%, but do range from say 5 to 12%, and these are dollar returns. For the mezzanine, averaging out at around 12%, but ranging about 10 to 15%. For special situations, which is more high risk, the returns are around 15%. Again, there's a variance there from 10 to 20%. And then for this distressed debt, again, more high risk. And so the returns there have averaged around 22%. Here, I just want to mention that these are very broad numbers, just because of the lack of data here. And also in the course of the research of this project, we did speak to a number of debt funds who also mentioned some of the target returns and realized returns, but on a confidential basis. And so those also went into informing the numbers we put on this slide. In terms of activity on the continent, over the past 5 years, so looking at between 2015, sort of the first half of 2021, which is when we commenced this study, and looking at more than 1,000 transactions across that period, looking at structured lending to the private sector. And so this includes a lot of project finance, it includes lending to corporates, and then includes also the published transactions by debt funds. So across all those, there's transactions of more than $193 billion in Africa. And the largest majority of this lending was by syndicates. So group of the banks and all banks and DFIs have come together to lend to, say, a real estate project. So that accounted for 119 billion. Individual commercial banks also lending here around $30 billion. And then when we come into the bracket of what can be considered private debt, so looking at what the multilaterals, the DFIs, and the specialist private debt funds lent, that was around $37.5 billion. And then the other bucket was by export credit agencies, around $7 billion. And then there was some lending by corporates, but it's below $1 billion. So the key takeaway here was that the bulk of private debt lending to the continent was by DFIs and MDBs. If we take those out, what was lent by private debt funds drawn from public sources was around $8 billion. Another point we can add here is that the investors in a lot of these private debt funds are actually the DFIs and MDBs. Looking at the regions and how the lending was split, we see on the continent, South Africa was leading, followed by Egypt, and then Nigeria and Kenya. Of course, there we can see a bit of correlation with the size of those economies, but Morocco really bucks the trend. So this is really striking given the size of Morocco's economy. And one of the reasons we thought this might be was just because of the well-capitalized banking sector in Morocco, which really does serve as the primary conduit of capital to the private sector. Looking at the sectoral distribution, and here we're looking only at the category we identified as private debt. You can see a lot of lending went to power and energy, followed by financial services, oil and gas, mining, real estate, and then manufacturing, and then telecoms and IT, and sort of agriculture and food. And then some of these other categories receive much less financing. In terms of the structure, how a lot of these transactions were set up, predominantly we saw crosses more than 1,000 transactions. This was really senior debt, accounting for about 84%. There was large buckets that the structure wasn't disclosed. Then we see mezzanine lending accounted for, say, 1.4 billion out of that 37 billion. The rest were really negligible. When we look at why this private debt space is important to Africa, really we see that if we look at credit to the private sector as a percentage of GDP, sub-Saharan Africa on the extreme right really is behind the rest of the world in terms of access to credit for the private sector. And looking at this on a more macro level, and the estimates of the financing required on the continent across sectors, the annual requirements are around between 130 billion to 170 billion. And this is driven by the infrastructure investment required on the continent to just basically improve the quality of life, improve trade, and improve the exports from Africa to the rest of the world. And then also looking at the growing population and the need to create employment on the continent. And if we consider the resources already available from the state actors and from development assistance, there's still a financing gap of between $52 to $92 billion each year. And so there's a need for additional capital to the continent. And that's where we think, as Brian mentioned, the institutional assets that are already there in the continent, there might be an opportunity to unlock some of those sources to go into this private debt space. These numbers do vary depending on which sources you look at, but South Africa has some of the highest institutional assets on the continent, looking at pension fund assets, Nigeria and Kenya as well, and then some of these other countries. So there is capital on the continent that can go towards private debt lending. It's more a question of how to package it, and we'll see that later on in the presentation. As I mentioned, as part of this, we had several one-on-one conversations with players from across different countries, especially in the 5 countries I mentioned, but really focusing on Kenya, Nigeria, Ghana, and Morocco. So just bear that in mind when we go through the recommendations. And these were recommendations to FSDA based on what the market participants reported as what they see as required for this space to be able to grow. So key findings were, there's the thought that hard currency private debt is really denominated by or dominated by MDBs and DFIs that have access to cheap funding, and so they're able to also lend at concessional rates or below market rates. And there's 2 sides to this equation. So on the one hand, they provide important precedents and show that transactions can happen, and they also give like a historical basis for saying like the perceived risk in Africa is actually lower than many people out there think it is. But on the other hand, they do provide competition for private debt funds and for other private debt providers on the continent. And just looking at the issue of precedents, one area we see this is in terms of infrastructure lending and looking at the default rates for project finance. Moody's looking at transactions over a decade and comparing Africa's default rates to the rest of the world. At around less than 5%, the default rates for Africa were better than some of the other regions where Moody's compared and looked at the infrastructure financing and project financing deals. So yes, there's potential for increased participation in private debt by domestic institutional investors, especially given the desire for higher yields. However, there's an aspect of risk and regulations which they need to navigate to be able to get into this space. We do see in countries where government securities are competitively priced, for instance, in Kenya, local institutional investors lack the motivation to pursue private debt opportunities because they're already in a relatively risk-free environment where they can channel a lot of their resources and not lose their members' money. So again, that's an impediment here if we're looking at what sort of pricing would be attractive to, on the one hand, attract the institutional investors, but on the other hand, be attractive to borrowers, considering the other sources of financing that are available. We did see where in Morocco, there is a desire to branch out beyond traditional asset classes, but the regulations there are quite rigid, and we'll cover this a bit more in the recommendations. And finally, the biggest issue and what this report and what we're looking to start to address is the lack of data on transactions on the continent. And so it's just hard for investors who already have capital committed to actually go out and find the borrowers, and also for the borrowers to just know that there's private debt available and the advantages of private debt, and looking at what funding opportunities there are and the ability to structure tailored to each company. So there's still that lack of connection there. And then on the other hand, institutional investors really kind of struggle to look at this space because they want to see the data and see what transactions have been done. If it's a fund manager, preferably not a first-time fund manager, they want to see a track record and just be able to make that assessment. Looking at the specific recommendations for the countries we were focused on, and this really, as I mentioned, came out as recommendations and what the participants thought FSD Africa could look at. In Nigeria, we saw the focus area would be to increase avenues for investment for these institutional investors by adding flexibility to invest in unlisted debt transactions. And this is because of current guidelines that impose a minimum BBB rating, and this needs to be by at least 2 rating agencies. So to be able to add this flexibility, this would require engagement with the regulator and just have additional conversations to see how to possibly allow these institutional investors to go into this space. In terms of when there's that additional flexibility, then the pension funds themselves would need the capacity in-house to be able to evaluate transactions. And it's a whole range going from developing the pipeline to actually managing a portfolio, or like finding the right fund managers to do that on their behalf. There's also a need for targeted credit enhancement. So I think the feedback here was in some certain sectors like real estate lending, it's well understood. There's precedents, and so when it comes to other sectors and looking at more early stage projects, there's a bit of reluctance to take on that risk early on. And so while there's liquidity available, there's just a need for possibly a third party to take some of that development or early stage risk, and therefore unlock additional investments to those areas. Some are just more basic. For instance, just having a standardized way of looking at how to structure a transaction and the documentation required. This would help both the borrowers and lenders just to be able to structure and move forward those transactions faster. And then the last recommendation was in terms of supporting local currency private credit vehicles, particularly those that specialize in more tailored financing, such as working capital solutions for value chain businesses, where banks would find it hard to finance given the non-traditional nature of these transactions. And looking at cash flows and so on. Coming to Kenya, I think here there was different set of recommendations, and there's already work going on. But the main thing was to develop the capacity of pension funds to actually be able to develop pipelines, to be able to structure and invest directly in private debt. So those who are in the private debt funds space know that there's a lot of work that goes into creating a pipeline and assessing it and doing the credit assessment, pricing the deal, structuring the deal, taking this through the investment committee, having the, what should we say, the standards required for ESG considerations and all this. So In Kenya, there's, for instance, the pension funds have come together in some of the pension funds at least. There's KEPFIC, the Kenya Pension Funds Investment Consortium, which brings together, I think now there are more than 27 pension funds who are looking to mobilize institutional capital for infrastructure and alternative assets investments in East Africa. So they're already starting to look at this. The key issue is just having that capacity internally to be able to do more of this. So they've set up a secretariat, but at the end of the day, the pension funds need to actually be able to assess these transactions that are presented to them. The other area of need we saw is really looking at providing fast loss capital to promote private debt transactions where they're perceived to be risky, just to encourage additional investor participation. And this would be especially beneficial for first-time institutional investors, just to get that experience and comfort. The other one was on hedging solutions, and this would allow hard currency funds, because there are a number of funds already active in Kenya, but they are hard currency funds. So give them an affordable way to develop hedging solutions so that they can participate in local currency transactions and deepen the pool of available capital in the country. And the last one was assisting with credit ratings. So assisting companies to prepare for those credit ratings. And this is just, even with a shadow rating, it will give investors just a way to objectively evaluate risk of transactions and to price accordingly based on their investment guidelines. Looking at Ghana, again, there's an emergence of local fund managers that are looking to set up private debt funds, for instance, Ashfield Investment Managers. And so the area of support here would be getting some of this, helping some of these funds get off the ground. It could be investing in them to be able to take on some of the riskier transactions, or just generally enable them to be able to have the first set of transactions to have a demonstration effect. The other one was just in terms of capacity building through working with the regulators. And here it's just increasing the awareness and allowing for more conversations and proper guidelines for private debt. And the context of this is really in Ghana. A few years ago, there was the need for a cleanup by the central bank of several financial institutions. And this really led to damaging of the confidence in the market, as well as the regulator wanting to really be on top of developments within the market. So the idea here was just to make sure there's regulator support for this. And then the third recommendation we had is, right now there are really no local ratings agencies within Ghana. There are international ones, and there are some neighboring from neighboring Nigeria. But the idea was just to make ratings more easily accessible, just to make it easy for institutional investors to be able to know how to categorize borrowers, and this would also help fit within current regulations. Coming to Morocco, the main issue here is just helping the regulator to develop the frameworks that will enable institutional investors to increase participation in debt markets. So for the regulators, it would be a matter of looking at what has worked well elsewhere, looking at what sorts of frameworks can be adopted. For instance, there's a new securitization framework that is under development by the central bank there, and some of the other regulators. So there's a need to continuously develop these laws just to give more flexibility to institutional investors in that market, because right now they're really limited in where they can invest. And the other one is more broadly looking at how to get more capital into the private sector. So there is a well-developed financial sector in Morocco, representation of international banks and local banks, but they really lend mainly to the blue chip companies. And so the idea would be to get them to expand their lending to the SMEs as well. And this is through just helping them develop the frameworks to be able to assess the risk of the SMEs and lend to this segment. And this would have a broader effect in expanding the amount of capital to the private sector within Morocco. So those are just highlights of the report and the areas we covered. Of course, we expound on these issues in more depth within the report, which I'll also add will be available on the FSDA website after this presentation, not immediately, but it will be published within a relatively short period. So as I mentioned, just wanted to cover highlights. So at this point, I think we can be able to go into the panel session. There were some questions on the presentation and what period we were covering. I think I can just answer those now, but we will have a very specifically a more in-depth Q&A session. But to mention, we were looking at the last 5 years. At this point, I'd like to prepare to go into the panel session. But just before that, I think we can just put up a poll question to the participants. Let's see if we can do the first poll question to the participants. Okay, we have it up on the Q&A. So yeah, just feel free to respond to that question. In the meantime, I just want to invite the panelists for the next session. And I will give the panelists a chance to introduce themselves, but I'll just mention them and then give them a chance to introduce themselves. So we have Nadine Quessi from the African Private Equity and Venture Capital Association. We also have Michael Sani from the CDC Group and Sosano from FSD Africa. Panelists, I think you can just introduce yourselves, and then we'll dive into the panel session. Thank you.
Thank you, Daniel. So maybe I will start. So my name is good evening, everyone. My name is Nadine Quessi. So I recently joined AFCA as the head of research, where I oversee the research work. And just a few words on AFCA. AFCA is a Pan-African Private Equity and Venture Capital Association, whose role is to promote a better understanding and impact of the private equity and venture capital industry in Africa. Thank you.
and maybe I'll go next. Thank you, everyone. Great to join you today. My name is Michael Sunny. I'm here representing the CDC Group, soon to be British International Investment. And CDC is the UK's development finance institution, really operating across Africa, Asia, and of late the Caribbean also, looking at equity and debt transactions, both direct and intermediated. So within that, I sit within CDC's intermediated credit team, and really our focus is on how we support lending to parts of the market that we think are underserved. And we do that, for the context of this session, primarily through 3 product sets. So first, private credit funds. And a number of the private credit funds that came up on the screen are examples of funds that we've backed in Africa, including Blue Peak Private Capital, Vantage Capital, Ethos Mezzanine, and a number of the funds managed by Blue Orchard. We also look at supporting the market through risk-sharing facilities with banks, including a recent risk-sharing facility that we closed with ABSA, a Pan-African facility supporting the microfinance segment. And we also look at broader structured credit transactions where we can be more flexible in the structures, and have looked at pool bond issuances, for example. So let me pause there and hand over maybe to Evans.
Yeah, no, thank you, Michael, and good afternoon, everyone. So my name is Evan Sosano. I'm Director of Capital Markets at FSD Africa, and I also represent FSD Africa Investments in the Africa Local Currency Bond Fund, the board and IC. Within the Capital Markets Department, we have operations in about 30 countries around Africa, but the priority countries for us is Morocco, Nigeria, Ghana, Kenya, and Ethiopia, where we have the bulk of our interventions on capital markets. Previously, many years ago, I was a fund manager, so I managed a fund that was the first international investor in many markets actually across Africa. So hopefully I have a few things I can be able to share about the different markets. So thank you very much.
All right, thank you, panelists. I think to start us off, and this question will be to Nadia. Right now, many African economies are coming out of the COVID-19 pandemic induced slumps. What role do you think public or rather private debt can play for these countries as they look to come out of economic challenges caused by COVID?
Yes, thank you, Daniel. And yes, as the world recovers from the global pandemic, the private lending industry can definitely play a key role in the post-pandemic recovery and as an opportunity to position, of course, itself as a strong partner and driver for long-term growth. First of all, I would say that, yes, among the many beneficiaries would be the SMEs, which continue to be at the core of the private credit and also private equity market. The SMEs we know employ more than 1 up to 2 people globally. They also account for around 90% of Africa businesses and are viewed as the engine to drive economic growth and development. So in this current environment that we all know, where many are struggling to access traditional lending, I think private credit can ultimately play a crucial role in supporting the Africa recovery. This was the first thing. The second thing, I would say that the private lending industry has shown it can put large pools of capital to work across different asset class, from the core infrastructure debt to venture debt. However, as shown in the report previously, South Africa lags other regions around the world in access to credit indicators as measured, as you've shown by the credit provided to private sector as a percentage of GDP, around 50%. So this means that there's still room for yes, additional investment in private debt to meet the gap, estimated to around, I think, if I remember correctly, 92 billion per year. And this can be definitely originated from the institutional investors. Finally, I would say that also the horizon of private lending can expand even more significantly, as the capital market recognizes today that it's possible to generate financial return while helping to address the key societal challenges. And yes, while focus on governments and environmental issues continue, we've learned through this crisis that social inclusion is not only for the impact fund, rather these issues need to be also an integral part of that recovery, and this trend being accelerated by the United Nations Sustainability Development Goals. Yes, definitely the private lending industry has a key role to play, and we know that these opportunities are also challenges, but the way for the industry to position himself as a strong partner. Thank you.
Thanks, Nadia. And I think as a related point, if we look at the role of this DFIs, and this question will be to Michael. So several issues do come up with DFIs. So first of all, DFIs already invest in private debt funds. And as you mentioned, CDC is an investor in some of the private debt funds, for instance, Bluepick. Looking at the way forward, is this an issue or a positive for this space, given that DFIs also directly do private debt? And the aspects of competing for the best borrowers with other players in the market, how do you view this involvement?
Yeah, thank you, Daniel. And it's a good question, and it's one we unsurprisingly debate a lot. I think there's a number of aspects to your question, so I'll do my best to touch on a few of them, but I'm happy to come back to any points that I've missed. I mean, I think firstly, leading on from many of the points that Nadia was making about the importance of private debt, I think the first thing to say is that there is still a huge mismatch in the demand and supply of credit to the market. There is a huge need of credit to African businesses, and only a small part of that is currently met by the existing market, with banks as primary lenders in the market. So I think it's important to look at private credit funds in a broader context of the fact that private credit funds, it is a nascent industry and they do exist, but they are a very, very small portion of the credit gap that still exists. And I think in that context, the point I would make is that some private credit funds are in the market now, but you really do need to see quite a rapid expansion in the supply of credit, whether that's through banks coming back into the market or more private credit funds and alternative lenders coming to the market. In terms of the role that DFIs play in that, I of course come to this discussion with some bias coming from CDC. I think DFIs in some ways are undoubtedly important. I think the DFIs have the ability to take really what I'd call first mover risk, and they have the mandate to do that. And that involves many things, including working with fund managers to, even before the funds are live, to structure the funds, to build the teams and the strategies, to engage with the funds, particularly ahead of first close, where considerable fundraising risk is often there, to work with first-time fund managers who often find it difficult to raise commercial capital, really to support team managers to prove their teams, to prove their track records, which enhances their ability to later go on and raise private capital, to support embedding of ESG and business integrity practices. And I think the aim really is that DFI should anchor these private credit funds and over time should be crowded out when sufficient private capital exists to capitalize these funds. And I think we see that is often a long-term journey. So that doesn't always happen in 2, 3, 4 years. But I think there needs to be a commitment from DFIs to really catalyze the asset class, and that's a multi-year journey. I think in that context, there always needs to be a focus on making sure that we're creating the right market to bring in private investors. In terms of what needs to happen for private investors to come into the market, the primary one is certainly that these private credit funds need to be able to prove their performance. And we have seen that with a lot of early players in the space, including the likes of Vantage Capital and 91 with their credit opportunities funds, really proving an attractive risk-adjusted return proposition that provides diversification often for private investors. And I think DFIs can also, as well as capitalizing and anchoring these funds, play a role in bringing or helping to bring more commercial capital into the space, really by sharing information and data, which to date has perhaps not happened as actively as it should have, but also keeping in mind as we shape funds and shape their strategies, making sure we're doing that and doing it in a way that's most attractive to bring in commercial LPs in the future. And in many cases, that might be local institutional investors. And a point was made earlier about local currency funds, and actually, do we need to look at more local currency funds to bring in those types of investors? But in the case of international institutional investors, it may well be dollar capitalized funds. And of course, there are other ways to bring in private capital into the private debt space beyond DFIs, and often that can be on a deal-by-deal basis without going through funds. And I think the report talks about support through credit enhancement, support through capacity building for some of these institutional investors. And I think people or organizations like InfraCredit in Nigeria have provided great demonstration of the ability to do that. Maybe the last point, Daniel, that I'll touch on is the point that you made around DFIs and kind of competing with private debt funds. I think we do see that in the market to some extent. I think that is, I wouldn't say inevitable, but a factor of actually the primary business of many DFIs, with CDC probably being a rare exception, is direct lending into the market. So I think it's perhaps expected that we see some overlap. I think what I would say is the guiding principle for DFIs has to be this idea of contribution or additionality, and that takes different forms, but really the idea that DFIs are lending directly to businesses where there is clear financial additionality, i.e. that the business cannot get the funding or comparable funding from any private players in the market, or where there is clear value additionality in that the DFI is specifically bringing an improvement in specific practices, whether those be around environmental, social governance, to the borrower that wouldn't have happened if comparable private capital come on. I think has to be the key one. I think where that sort of additionality or contribution doesn't exist in a strong way, DFIs shouldn't be crowding out private capital. And I think there are ways actually to develop more private credit funds in the market or debt funds in the market that have a differentiated offering to the DFIs. And I think one way may be looking more at local currency funds, where DFIs find it particularly challenging to play given their balance sheets. But that's a long answer to your question, so I'll stop there.
Yeah, thanks, Michael, for the additional context there. And you mentioned several key concepts like additionality, just a mere factor of making additional capital available, demonstration effects, differentiation. If we go back to the area of increasing capital to this private debt space, and I'll put this question to Evans. If we're looking at how institutional investors should think about risk and approaching this alternative asset class, that is private debt, while at the same time protecting the capital base. How do you think they can go about this?
Yeah, thank you very much, Daniel. So maybe if I step back a little bit and say this, we've been talking a lot about this space being dominated by hard currency investments, by DFIs and all that. So the question is, how do we get local domestic institutional investors much more involved? Unfortunately, we are starting from a good point in that sense that if you look at the assets under management across the continent, we are now talking about $1 trillion, which is sizable. In the 4 markets that was the focus of this study, Kenya, Nigeria, Ghana, Morocco, we are talking about $130 billion of assets under management, sitting between pension funds, insurance companies, all collective investment schemes. Now, the challenge that this capital faces is that we have what we call physical dominance in many of these markets. So therefore, very high interest rates being offered by governments through government securities. And because of that, then the ability or the willingness to diversify, to take on extra risk is very minimized. So the industry generally has become very commoditized. And over time, I think the pressure will be coming through in terms of even fees for assets under management. So there's need for, I think, differentiation. There's also need, I think, for these funds to start considering how they can invest prudently, but also make a contribution to the economic development of the regions and the continent. But they have to do that in a manner that safeguards capital or protects the capital and enhances hopefully the return a little bit. So it has to be a process that has to be, I don't know what to say, cautious, but it has to be quite informed. So some of the strategies I think they can apply to get into this space may include co-investment with the more experienced investors, maybe sometimes alongside DFIs. We have not seen a lot of that happening, but I think that is something that we can encourage. And then, of course, encouraging fund structures is better than encouraging them to consider individual investments, because that requires them to have very strong credit appraisal skills, which is lacking. So a portfolio approach through a fund, I think, will be good. And of course, through the fund, you can have layering of risk so that the pension funds come in at a more senior level and reduce their potential capital loss. I also like the idea very much of credit enhancements, and I think that what InfraCredit Nigeria has done is provided a very good demonstration. I think that is a concept, or perhaps a structure that can be replicated in a number of markets, because a lot of these investors, as we said, their credit culture is very weak. So having an entity being able to cover the credit risk to start with, maybe 100% RAP, is good. And then as they become more familiar with the credits and all that, then they can you can reduce the amount of enhancements you're providing in individual transactions, all in the funds. One other thing I've seen lacking in many markets is that a lot of the institutional investors, maybe this is also related to their capacity, do not demand ratings, especially in markets where they're not mandated. And it actually surprises me that a lot of those investors don't demand ratings, and not ratings so that they can outsource their credit analysis, but also to give them a sense of another view of the credit and all that, to compare with their own models if they're able to do that. So I guess that's some of the areas in which they can get involved. And then the final thing I think I could like to say is perhaps there might be an opportunity to consider sponsored funds, and for entities where they've had like in KEFIC, the KEFIC situation that Daniel mentioned, you mentioned at the beginning, where there's already an association of fund managers and all that, coming up with a sponsored fund concept might be something to consider. And as FSD Africa, actually will be quite happy to work with the entities that are looking at those kind of opportunities as well, because it's one way of learning and easing yourself as a fund into these investments. So let me stop there, Daniel. I don't know whether there are areas that you want me to emphasize a bit more.
Thank you, Evans. Potentially, I think maybe, and I can open this to the other panelists as well. I know in some quarters, ESG considerations play a big role, especially in Europe, North America. In Africa, maybe not as prominent a role as some of those other markets. Maybe you can comment about that and also the other panelists as well.
Yeah, thank you, Daniel. I think I like maybe Michael and Nadia to comment on that first, then I can weigh in.
Yes, this is Nadia speaking. Yes, concerning the ESG consideration, from my perspective, I would say that even if we lag behind over the region, the consideration of ESG are high on the agenda of the fund manager operating in Africa, what we observe generally. Because of the early involvement of the DFIs in catalyzing the growth, in Africa, PE and VC, specifically industry, it means that impact and job creation and sustainability have been always at the core of the fund manager decision making processes. And according to our last survey that we produced back in April 2021, every fund manager that participated in the survey viewed the ESG factor as very important. And in recognition of its importance, when investing in Africa PE, 95% of these fund managers participating in the survey have a responsible investment or ESG policy in place. So which is, I mean, quite important to know. And in line with this importance of ESG consideration within the PE and VC industry, we also produced a report on the private credit landscape. And here again, we've seen a high consideration on this topic, and we think that will continue because according to all the interviews that we proceed with the main private debt players in the industry, all of them stated that ESG is very, important for them and constitutes an integral part of their investment approach and substantial component of the investment criteria. So yes, I'm just also curious to know about your views on it. Michael, maybe?
No, absolutely. And I would agree with everything that you've said, Nadia. I think there is perhaps a couple of drivers. I think much of, as Daniel said in the report has shown, I think much of the, in the private debt space, I think much of the precedent has come from DFIs and MDBs, who of course have ESG as core to their mandates. I think as we see many of the private debt funds that are in the market today anchored by DFIs, particularly in early vintages, it embeds an approach to ESG really at the center of the fund's decision making by virtue of the LPs capitalizing the early vintages of the funds. And I think that is one aspect of it. I think the other aspect of it, though, is an increased appreciation that really management, particularly of ESG risks, helps reduce the inherent risk of the portfolio commercially. I think also it supports the ability for those underlying businesses to access funding in the future, increasing valuations, increasing exit opportunities. So I think there is both the aspects of DFIs have played and MDBs have played an important role in terms of setting the standards. But I think increasingly, actually, the commercial case is starting to take over and really be the key driving force.
Yeah, so I think if I can just add maybe 2 points. One is that I think there's been, in Africa specifically, a lack of appreciation among institutional investors on the role of ESG. So there's of course the risk aspect of it. So you're managing the risk in your portfolio by focusing on this area, but also there's the opportunity. And I think many repeated studies have indicated that companies that adhere to very high ESG standards generally outperform those that do not. But of course, that might not be true in the short term. So that's also, again, something requiring investors to change their mindset from very short-termism to slightly more long-term kind of orientation and all that. But I noticed that in a number of markets, this is also beginning to seep through. For example, in Kenya, we have the stewardship code. We have similar codes in South Africa as well, and I think other markets also considering the same. It's very important because then it ensures the fund managers who are managing assets on behalf of others taking into consideration those ESG aspects in the investments.
Right. And I think those are all very important considerations to have in mind in this private debt space. So I'm just keeping an eye on the time. I think we can pause the panelist session here, and I want to give a big thank you to our 3 panelists for today for taking time to shed more light on this space and to answer our questions. We have a few more minutes so we can look at some of the questions that have come in via chat and the Q&A function. But just as I look at those questions, I'll read them out, and probably we can see who among the panelists would be best placed to answer. But just before that, I think we can put up a second poll question to the audience, just as we compile these questions. Kindly take a minute to respond to our poll questions. But looking at the chat, one of the first questions was from Ricky, asking for elaboration on special situations when it comes to private debt strategies. And I can answer that one. So special situations in private debt, we're looking at more opportunistic lending. For instance, if we're looking at a downturn caused by business cycles, or like in 2020, 2021, there was a lot of businesses in distress caused by COVID. So in that case, a private debt fund could lend to those businesses, of course, knowing that the business cycles would turn again and they would be able to make a good return on the investment. So special situations is really a more opportunistic lending strategy. Another question we have is whether the presentation slides will be available afterwards. I think, yes, we will be able to share the slides with the attendees. A question here on what industries or sectors do we see as being frontier markets in the next 5 years for private debt? And tied to earlier questions, are there African economies that we foresee coming into play a bigger part in the private debt space? Maybe I can start and then pass it on to maybe Michael and some of our other panelists. As we mentioned in the emerging trends, we do see the private debt really looking at areas that are of interest to development actors. And more recently, climate resilience has been a key focus on the global agenda. And so looking at transitioning to low carbon, I think, is one of the areas that will see growth. Of course, in addition to some of the infrastructure investments and access to energy, I think those will continue being key themes in the next few years. I don't know if Michael, you have any thoughts on those areas.
Thank you, Daniel. I mean, I largely agree. I think actually we'll continue to see a broad range of sectors remain attractive. As you say, I think the 2 or 3 themes that I would expect to increasingly attract focus are, I mean, climate in its broader sense, from renewable energy to energy efficiency to areas like clean transport. I think will increasingly attract much funding. I think we will continue to see a support for funds investing with a gender lens, even if they are journalists. I think that will continue to be an important focus. And I think the third I'd call out is this idea of technology and digital innovation. I think we've seen it more on the private equity venture capital side. I think increasingly we're seeing kind of early movement in venture debt. But I think that's another theme that will attract more and more attention. That said, I think really across the traditional sectors that have been important, particularly for from a DFI perspective, that create significant that contribute to productivity in economies, that create significant jobs. Areas like manufacturing, I think, will continue to be those more traditional areas. I think will continue to be prime targets for the private debt funds. But in terms of emerging themes, the 3 I mentioned about climate, gender lens investing, and technology, I think are the ones that will see the biggest or the most kind of exponential rise in funding towards.
Thank you, Michael. I think because of time, probably we can move on to another question. There's a question here of whether grants fall in the realm of private debt. So grants would be separate from private debt. And in the transactions we looked at, this was actual lending to the private sector, so excluding grants. There's a question here on whether the return spectrum is in USD. Yes, that was in USD. There's a question of the average tenor of senior debt versus mezzanine. Again, here, going by the public or the published transaction details, this information really wasn't available for all the transactions we looked at, so we weren't able to analyze that area of tenor. There's a question of whether these are realized or unrealized returns. So there are a mix of realized and what the lenders would price at when making the loans. So it's a mix of realized and expected. There was a question of are institutional investors looking to receive capacity to look at individual transactions themselves or to co-invest alongside investment managers? Here there was a mix. So there are those institutional investors that have come together to form a consortium to look at these investments. But the issue is, on a day-to-day basis, at the, say, the pension funds, there really isn't that capacity to be able to evaluate these transactions. So I think it cuts across both, looking at individual transactions and co-investing alongside investment managers, so actually investing in this investment managers. And going back to what Ivan said, just in terms of practicality, maybe the better approach for them is to look at investing in professional fund managers that have how should we say, structured funds, and outsourcing that function to them. Let me see if there are any additional questions, or if we've covered the bulk of them. If there are any other questions, please put them in the Q&A, and we will get to them. And maybe as I do that, I think we can get the final poll question before I invite Evans to give closing remarks. All right, I think then, right, I can invite Evans to give closing remarks. Evans.
Sorry, Daniel, I think there was one more question, so maybe we can just quickly
yes,
finish that one here.
Yes, please. Could you pose the question?
No, poll question, I mean. So yeah, once the participants are done with the third one, we can put up the fourth one and finish.
Okay. Okay. The fourth poll question has been put up. I thought you were saying there's an additional question from the audience. Thank you, Brian. All right, Evans, I think please we'll give you this spot to do the closing remarks. Thank you.
Yeah, thank you very much, Daniel. So I have just very few remarks to make. First of all, thank you, Daniel, for taking us through the presentation. Thank you, Nadia and Michael, for participating in the panel discussion. Brian and the whole team at FSD Africa for making this happen. We very much appreciate that. And of course, the various respondents to the conversations that we've had on this topic in different markets. So thank you very much for that. And I also thank the participants who have come in today. I've seen quite a number of familiar names in different markets. So thank you for finding time to participate in this. So we are not doing this study at FSD Africa as an end in itself. We are hoping to take away some things, some learnings, things that we can do to support market development, and also find ways in which you can partner with the different champions in the different markets. As we've heard today, there's been a lot of focus on foreign currency, private debt. Of course, we want to make the continent much more attractive for more flows. It's much needed because the gap is huge, and especially for priority sectors, especially for green, we really want to encourage international flows in, but we also want to work very hard to increase the local currency financing component. And in this, we are looking to partner with the domestic institutional investors and the fund managers and others to support that. One thing that came striking for me from the report is that on the regulatory side, it appears that it's not a major problem in many markets. If you look at Nigeria, you look at Ghana, Kenya, maybe Morocco is a bit of an issue, but in those markets, regulation is not a problem. So there are other barriers why we are not attracting domestic institutional investors into the private debt market space. And we are very happy to try and explore how we can address some of those challenges. And I think there are quite a number of good ideas that have come through there, how we might be able to promote market infrastructure, can I say institutions like the infra credits of this world that provide the credit enhancement, how we can promote perhaps credit ratings where it makes sense to do so. And in addition to that, what we are really interested in as FSD Africa is that the transactions. How do we actually make the money move from where it is available to where it is needed? How do we de-risk that investment so that the money can actually support the economic transformation in the continent? So we are very open for opportunities to discuss with the participants and others who are interested in working with us to try and resolve or solve this problem and make the funding, flow to where it is needed most for the benefit of the African people and the continent as well. So with that, I would like to say thank you once again. And we do have a number of initiatives going on as well. So it's not we're starting from scratch. One of those initiatives that I like to call out is the Africa Pension Supervisors Network, which has 10 member countries, including Ghana, Nigeria, Kenya, I believe Egypt as well, and others as well, and South Africa, to try and address some of these issues, including the ESG issues for institutional investors across the continent. So thank you once again, and I look forward to further engagement on this topic and other topics that may be of interest in deepening and developing the capital markets across the continent. Thank you.
Thank you very much, Evans, and thank you to all our attendees. We'd like to wish you a good afternoon. As we mentioned, we will be sharing the presentation from today, so please look out for that. Yeah, thank you very much.
Thank you.